Stocks closed higher yesterday as bank stocks rebounded and new economic data showed inflation is slowing down. Inflation rose in February, but was in line with expectations. The Consumer Price Index increased 0.4% for the month, putting the annual inflation rate at 6%. And joining us now with some supersized charts, former Treasury official and Morning Joe economic analyst Steve Rattner. So, Steve, tell us, I love this new setup you have here. This is really going to help tell the story. Where do we stand with inflation, the economy, and what are you looking at today?
Sure, Mika. Well, as you said, inflation looked to be coming down if you look at the headline number from 6.3 to 6 during the month. But the numbers are very squirrely still at the moment because of COVID-related things. So we have to look behind the numbers at some more interesting and hopefully relevant data. So what we've done over here is we've looked at 3-month annualized numbers for the CPI, and we've broken it into 2 buckets. The headline number, which is the number that you report and everybody reports up front, and then what we call core. We take out food and energy, which are very volatile, and the Fed does not look at that closely in terms of deciding how much inflation is in the economy and what they need to do about it. And then we break that down a little bit further into core services, your lawyers, your doctors, travel, all that kind of stuff over here, and then goods, whether you're actually buying a new car or something of that sort. And what you see on a 3-month trailing basis is that core inflation actually accelerated a bit. That's not good. Goods inflation is still falling, not as much, but that's okay. But what the Fed really looks at is core services, and that is rising, and that is not a good thing in terms of getting inflation down to that 2% level, which you can see is way below where it is at the moment. But if you look over here, you can see one of the reasons for what's going on out there is the economy has been running stronger or hotter, as we say it in the parlance, than it had been running. Coincidentally, right up until the last Fed meeting, at which they increased interest rates by 25 basis points, you can see a quarter of a point. You can see that the economic surprises, so to speak, how the data comes in relative to how economists expect it, was positive, cooler. It looked like the economy was cooling. And then suddenly it kind of turned around over here. It turned around on a jobs report for January that came in over 500,000 jobs relative to 300 some odd thousand expected. February also the jobs numbers came in too hot. Retail spending numbers came in too hot. And so suddenly the Fed was facing the prospect of having to increase rates more. Then the next thing, of course, that happens is Silicon Valley Bank. And Silicon Valley Bank has a real effect on the Fed in so many different ways in terms of trying to make it easier for the banks, trying to deal with the macro effects on the economy and so forth. And what this chart shows is the progression of the market's expectations of what would happen to interest rates. So if you go back to the beginning of February, everyone thought, this pink area, that we would continue to increase interest rates by about 1/4 of a point. But then as the economy got stronger, my second chart with the surprises, people began to think, oh, no, maybe we better have a 50 basis point, a 0.5% increase in interest rates. And then right over here, Jay Powell gave his normal testimony to the Senate, and you can see that the expectations for 50 basis points shot up all the way down to here. And people said, oh, yeah, the economy's hot. We're going to have to really cool it off. Then comes Silicon Valley Bank, and the whole interest rate market flips around. And now the betting is 78% that we will get 1/4 of a point next Wednesday, and the balance that we'll get no increase at all. And so this is what Jay Powell and his colleagues are grappling with, which is how to balance the fact that the economy is still running hotter with the fact that we are now seeing the stresses and strains in the banking system and a lot of other concerns still going on in the banks. And apropos your last discussion, there is real concern about other banks and what depositors are going to do and whether depositors are going to flee those banks and what that will do to the financial system if that happens.